So good afternoon, everyone, and welcome to this Oxfirst webinar. My name is Adam, and I will be hosting the event today alongside our excellent panel of speakers. Before we begin with the presentation, we'll take a few minutes just to outline the format, as well as tell you a little bit more about Oxfirst. So the event today, following the introductions, we'll have about 35 to 40 minutes worth of presentation, and then we'll have a Q&A session at the end. You can submit questions throughout the course of the presentation using the Q&A button, which should be at the bottom of your screen. Please do that throughout. We'll get to those questions at the end, and we'll pass over to the speakers who'll be able to answer those. To give you a little bit of background to Oxfirst, Oxfirst is an IP consultancy formed by academics out of the University of Oxford in 2011. We complete IP valuations to assist businesses in unlocking the maximum value proposition from their portfolios. We also provide expert analysis for litigation and bespoke research projects examining IP and its implications. We're based in London and in Oxford, and we continue to maintain very close ties with the university to this day. We publish regularly on the important matters in IP at the moment, and we host webinars such as this on a very regular basis. And the best place to stay abreast with those is on our website and by following us on LinkedIn, where we publish those on a very regular basis. About our speakers today then, our first speaker, Gerard Torres, is a senior research economist at the USPTO. Since joining the USPTO, he has forecast the agency's revenue and helped shape its financial policies. He's led efforts on financial policy changes for the America Invents Act and has implemented regulatory changes, including setting and adjusting user fees. Gerard has a background in economics from the State University of New York and a master's degree in applied economics, also from the State University of New York, alongside a master's degree in computer science from the Georgia Institute of Technology. Our second speaker is Dr. Walter Park, who is Professor and Associate Dean of Graduate Studies in the Department of Economics at the American University, Washington. Dr. Park is a Professor of Economics and the Associate Dean. He works on the economics of technology, growth, and development. He focuses in particular on IP systems, R&D spending, multinational firms, and international knowledge transfers. Dr. Park earned his bachelor's degree in economics and statistics at the University of Toronto, his master's degree in economics from the University of Oxford, and he achieved his doctorate in economics at Yale University. Our third and final speaker is Dr. Ryan Hughes. He consults for the USPTO as lead economist, and he is predominantly focused on IP valuation, risk modeling, competition, and strategy. Dr. Hughes has a background in maths and economics and a master's degree in maths and statistics from Georgetown University, and he achieved his doctorate in economics at the University of Chicago. And with that being said, I'll now hand over to Gerard, who will begin the presentation.
Thank you, Adam. Pleasure to be here. Let me pull up my slide deck here, and hopefully everyone will be able to see it. Okay. I apologize. Doesn't seem to be working quite right at the minute here. Let me try again one more time. Okay, how about now? Is that coming through now?
Yes.
Okay. Okay, let's get started. Well, thank you for joining us for this lovely webinar. To give you a little bit of background, myself, Walter, Ryan also worked with yeah, Andrew Toole, who's the chief economist at USPTO on this study. And we've been doing this for a little while now, and we've been delving deep into this aspect of patenting, which will explain exactly our motivation and how we look at the secondary market for patents and explain the relationship between the two. So to get started, I'll explain kind of our motivation for this study and what we're trying to accomplish. And as mentioned, at the USPTO, as you can imagine, we've experienced quite the boom and bust in patent application filings over the year, primarily due to different economic shocks or the business cycle changes as a result of changes in the economy. And this has large ramifications for the agency as a whole. In general, we try to do our best to forecast the demand for patent applications. This has an important role in the finances of the agency as a user funded agency. The USPTO collects revenue for the services it provides, including the filing of patent applications. It also has a significant impact on the operations of the USPTO. In order to process all of the applications, we need to make sure we have the appropriate number of staff available, particularly patent examiners. And if we are not careful in how we evaluate the future of patent application filings, we may be not have enough patent examiners to examine all the applications in the appropriate amount of time that we would like, or we may be short of examiners if we have too many applications coming in and not enough examiners. Then we could also have trouble there. So we have to make sure that we balance the two, that we have the appropriate amount of staff given the amount of demand for the applications, and we also have to make sure that we balance our finances. And so this has been quite the uh, task for the USPTO as an agency, because we have these economic fluctuations and they're difficult to understand what will the impact be on the demand for patent applications. In particular, I think you can see here in our graph, we have, you can see this chart on the patent applications filed by year. And you can see our last three economic cycles. You can see the internet.com boom and bust. You can see the Great Recession, and on the right here, you can see the COVID pandemic. And you can see that they had very different impacts on the demand for patent applications. The internet.com boom and bust, you can see we continue to see a growth in patent application filings during this time period. Doing on an annual basis, you can see that it seems pretty smooth. We continue on trend for the most part during this internet.com boom and bust and this recession of the early 2000s. But then we had a quite different experience during the Great Recession or the financial crisis, where you can see from 2008 to 2010, there was a decline in the number of utility patent applications filed at the USPTO as a result of this economic bust that we saw in the broader global economy. Then, if we move forward here to the end of our chart during the 2020 time period, you can see that the COVID pandemic really also displayed some interesting behavior from the patent application perspective, in that we saw a continued growth in application filings on an annual basis. Now, looking at an annual basis, it hides a little bit of the fluctuation that we saw in patent application filings. There was some drop in filings during the initial onset of the pandemic in the United States in March 2020, but there was a strong recovery, and you can see here that it continued after the pandemic well into 2022. So we wanted to set out to understand why this is occurring. What is the motivations? What are the factors that influence people to file patent applications, even in the face of this economic uncertainty, where you're not sure how you're going to be able to commercialize your inventions. You're not sure what the return on investment of seeking patent protection will be. There's a lot to consider. And when you're facing these bouts of uncertainty, or when you're facing a recession, or on the opposite end, if you're facing an economic boom, how do you make decisions on whether or not you want to file your patent application. So that was our motivation. We wanted to look at this and we wanted to understand how the changes in economic uncertainty impact the determination of applicants to file their patent applications at the USPTO. So hopefully here you can see the next slide. We're looking a little bit closer at the pandemic, at the real U.S. gross output during the coronavirus pandemic. And you can see here that we, in the US, experienced a different sort of impact of the coronavirus pandemic by different industries. Now, here we're looking at non-IP intensive and IP intensive industries. And for that, we use a previous report that we do at the USPTO where we call the IP intensive industries report. And we determine based on the amount of IP assets held by different industries if they're intensive or not intensive. So intensive would be industries that hold an above average number of IP assets, and non-intensive would be a below average number of IP assets. And what we're trying to display here is the difference in the impact of the coronavirus pandemic to IP intensive industries and non-IP intensive industries. And you can see the non-IP intensive industries experience a greater decline at the beginning of the coronavirus pandemic as a result of this economic uncertainty and the upheaval that was experienced during this time period. Now, while there was a rebound for the non-IP intensive industries, I think the main thing we want to take away here is that the IP intensive industries experience less of a decline in their real gross output as a result of the pandemic, and also had a stronger, quicker rebound, although there's convergence towards the 2021 time period. And so this is another aspect that we investigated. We wanted to see, why this is occurring. What is the impetus for, an IP intensive firm or IP intensive industries being more resilient in the face of economic uncertainty than IP intensive industries? So we delve a little bit further into this, and we wanted to look even further at a granular level at the patent application filings themselves. And again, we're still focusing here on the coronavirus pandemic because obviously this was the time period that was really, confusing for us at the USPTO, where we saw, this initial dip that we discussed, and then we saw a strong rebound in patent application filings. So here again, we're looking at utility patent applications filed, and we're looking at different technologies. So the blue line here are digital technologies, and we've defined that as our IT software kind of related technologies based on their common patent classification symbols. And then we also have our health industries, which are, our biotech, our pharma companies, and those are displayed by the dotted black line. And then all of the other industries are represented by what we call traditional industries, or the red line. And again, here you can see there's a very different experience for these three different industries. You can see that the digital technologies, the digital companies continued to file applications throughout the pandemic, and really displayed a strong growth in filings in 2021. The biotech companies, the digital health, the health companies, also continued to file a good amount of patent applications during the initial onset of the pandemic in the United States, and also displayed good growth during this time period. The opposite of that, obviously, are the traditional technology, the traditional firms that are not in the digital or the health industries, and they experienced a significant decline, as you can see here, relative to where they started in the beginning of 2019. So you can see the red line shows a dip at the beginning of the pandemic, on the outside of the pandemic in 2020 second quarter, and then slowly but surely they start to rebound, but not until the 2020, the second quarter of 2021, and still that is below where they started in 2019. So we can see here that there's quite a difference in the resilience of these industries and how they file their patent application filings. So this was something that also motivated our analysis and our research and to understand why we're seeing very different outcomes for these different industries. So as mentioned, our purpose is we want to understand how economic shocks affect a firm's decision to seek patent protection. We ask kind of the following questions. Do firms decrease their patent activity amid economic shocks that create uncertainty for the future financial returns? So we would assume intuitively, as there's an increase in uncertainty, that this would have a negative effect on firms seeking patent protection or filing their patent applications. And we'll see that the results are a little bit ambiguous in this matter, and we'll discuss that a lot further, obviously. Another question we want to look at is the access to secondary markets for patents. If you have access to the market, if you can sell your patents or license your patents or in some way commercialize them, does that affect your decision to seek patent protection now in the face of economic uncertainty? And we also wanted to measure what is a sufficient amount of access to the market in order to switch your impact of uncertainty. Or in other words, how much ability do you need to monetize your patents, either by selling them or licensing them, in order to change your thinking about economic uncertainty when you're faced with these economic shocks? What'll change your mind about whether or not you want to file your patent applications? And so these are the main research questions we wanted to address, and we'll discuss them as we go ahead here. So in economics, there's a theoretical framework called the real options framework. And essentially, this framework was developed over many years by a famous economist called Pindyck and Abel. And they developed a methodology for determining whether or not firms or companies or people would make investments in capital, or primarily they focused on tangible investments like machines or real estate, other kind of physical capital investments that a company would typically make. There is some literature to a much lesser degree on tangible investments, and we'll discuss why that's important. But a patent being an intangible asset has different properties than a tangible asset. So therefore, the ability to either divide or resell or recoup investment in a tangible investment is different than an intangible investment. And that'll be very important into our analysis and how we develop our study. So in general, to simplify this economic theory, we have a couple of different aspects that we want to point out. And the first thing that we want to determine in this real framework is that patent applications can be expanded, or in other words, they can be filed sooner, or they can be filed later. Now, with patents, there's trade-offs with this. There are certainly legal ramifications on filing sooner versus later, and there's a lot to consider from the patent prosecution perspective. So it's not as simple as I can just file them sooner or later, but there is some ability to navigate the patent system, particularly in the U.S., where you have many different forms of filings, and they have different application aspects to them that can determine your priority date. You have some ability to change the date that you submit certain information to the USPTO. So there is some ability to expand or file sooner or contract to file later. Of course, it's not perfect, but there is some flexibility there. The other important aspect that we want to consider are the returns that you get, the return on an investment. When we look at this and from the real options framework, we can say that firms can potentially resell their patents at a later date, and we'll call this a put option. So if you determine you want to seek a patent and later on in the future, you determine that patent may not be as valuable as to you and your firm as you initially hoped, there is the ability, or at least some ability, to exercise your put option and sell or potentially license your patent and recoup some of your investment. Firms can also go out and acquire patents at a later date, and we'll refer to this as the call option. And there's a market for patents. There's a market for some technologies. We'll discuss this a little bit further. It's not a perfect market by any means. There are some limitations to the market, as we'll discuss a bit later. But there is some ability to go out and acquire or license and do licensing deals for patents. The last point that I want to make here is that we're kind of looking at the value of the call option relative to the value of the put option. And a higher value of the call option creates incentives to postpone patenting because you can potentially resell or license your patents later, while a higher value for the put option creates incentives to patent currently or sooner rather than later. So how are we going to assess the firm's decision to seek patent protection? We would say that greater uncertainty has an ambiguous effect on investments in patents because it increases both the put and the call options, as we discussed earlier, your ability to either sell or purchase patents or license patents. Greater uncertainty has increase in value of both. So how do we determine which one is more important for a firm in their decision? Well, the secondary market for patents allows us to look at investments and see if they're reversible. The more reversible your investment in patents, the greater your incentive to innovate and seek patent protection. So for our study, we're focusing primarily on this reversibility or this put option so that you can sell or license your patents to others. This will have a big impact on whether or not a firm decides to seek patent protection in the face of uncertainty, as we'll discuss more in further detail later. But the main things we want to point out is a firm can reverse or recoup their investment in patents, and patents are not a sunk cost. Firms can still seek patent protection and be able to some degree, recoup their costs, as we'll see a little bit further here. When we started the study, we went through a literature and there was no consensus on how to measure economic uncertainty. So this was very meta. There was uncertainty about how to measure uncertainty. And so we decided to try a few different metrics of uncertainty. And you can see here, we have 4 primary metrics of measuring uncertainty. And essentially, the first method, we look at the variation in the sales and profits of a company. And we use that volatility in their sales and profits to determine how much economic uncertainty each firm in our data set is experiencing. The second method is maybe familiar to economists, but to the non-economists, essentially what we're looking at for the second method from Gusal and Lagani is just to look at what companies would kind of expect to forecast for their profit versus what do they actually experience. What is the difference between what they had budgeted and what they actually experienced? And we're looking at that as one of our second metric of uncertainty here. Our third metric comes from the literature from Boone and Van Reen, and they look at the volatility of a company's stock relative to its industry and its market index. So for this one, again, we're looking at the volatility of each firm's stock, and we're trying to hold constant for their stock price relative to their industry and the market as a whole. So again, this is just a different way of looking at volatility and looking at it at the stock price. And then finally, our fourth method is the Baxter-King method, and that comes from Hingley and Park. Our own Dr. Park was with us today. And this one focuses on the sales per worker and provides a cyclical component to real sales per worker. And this focuses a little bit more on cyclical trends or the actual changes in the overall business cycle relative to where we would be if we just kept growing constantly. I wanted to go in a little more detail on how we put together the data for this. So first, we started with what we call an unbalanced panel data set. Essentially, what we did is we looked at the roughly 1,800 different companies that accounted for 40% of all U.S. Uh, patents granted from 1990 to 2021. We looked at the data at a quarterly level, and I'll explain a little bit further on how we put together our data set. But this is just give you a good idea of what we started with. And the data represents, as I said, about 40% of all patents granted during that time period. We have firms that represent 15 different countries and 94 different industries. For our final analysis, we had to simplify the data set a little bit. And I can tell you that our results are very similar for the unbalanced and balanced. But for the sake of producing a final model, we needed to move to a balanced set. And that essentially means that we needed companies to be in our data set for the entirety of the time period. So instead of looking from 1990 to 2021, we were only able to use 1995 to 2018. And that was primarily due to the number of companies coming in and out of our data set. As you can imagine, from 1990 to 2021, there was a tremendous amount of change in the companies that were patenting. And that had to do a lot with companies going out of business, companies being merged and acquired. So we needed them to be in our data set for the full time period. And that kind of limited us into the number of companies we could look at. So we went from 1,800 companies to 491 companies for our final model. And this helps us to kind of avoid some of the problems of bias in our model as a result of this. And that's very technical in nature for the econometrics part, but we can tell you that we looked at both, and the results hold for both data sets. For our data sources, we looked at both the number of patents granted and also the number of abandoned patent applications. So for the granted patent applications, we get this from USPTO's Patents View website, which is publicly available. People can go and download the data. For the abandoned applications, we were able to gather information from USPTO's PALM system, the Patent Application Location Monitoring System, which includes applications that are unpublished and not available in public data sets like Patents View. And we wanted to add these abandoned applications to get a better idea of patent application filing activity during both economic uncertainty and also the change in publication rules that occurred in roughly 1999 as a result of the American Inventors Protection Act. We combine this patent data with firm financial data, which we get from Standard & Poor, their Capital IQ system. And this also includes name disambiguation. So patent applications are provide an assignee or an applicant, primarily an assignee we use, but those assignees can be subsidiaries of parent companies. And we use both Capital IQ and this National Establishment of Time Series to do our firm disambiguation. So we can go from a company subsidiary and put them to the proper parent organization or their parent company based on the data that we have from both Capital IQ and NETS. For our look at the secondary market for patents and looking how we can reverse investments in patent applications, we look at both the data from Richardson and Oliver Insights, which we'll refer to as ROI. They're a big broker of patent sales in the United States. They're the biggest brokerage in putting parties together to do packages or deals of patents, and we'll discuss that a little bit further on the next slides. But as a robustness check to further our analysis and see if we're getting the same results, we also get data on patent licensing transactions. And this comes from the USPTO's assignment records or assignment data set, which is also publicly available on the USPTO website. And finally, we use the US Bureau of Economic Analysis on their website and their data to get business cycle data to help us with that method of uncertainty that we talked about before, the Baxter-King method. So after we gathered our data, as discussed, we had to do this in disambiguation exercise, which essentially is matching assignees of subsidiaries to parent companies. Uh, this took quite a while because, um, as we discussed, there can be many different subsidiaries, and there can be many different spellings or ways of formalizing those subsidiaries, and we have to account for all the different variations and assign them to a parent company. And we also had to do this for the abandoned patent applications, as we discussed, which in some cases may or may not have an assignee, in which case we had to use some other data, such as the patent family data, or we had to use the name of the inventors to determine who the appropriate parent company was for that particular patent application filing. And then after we have all of the applications matched to a parent company, then we have to grab the firm level data that we'll discuss a little bit exactly what data we're getting from Capital IQ to get their financial data. And we make sure that we convert all of our financial data to real 2012 dollars. So the final part that we need before we can run our analysis and show our results are this aspect of the patent secondary markets that we discussed are important for our reversibility of our investment into patent applications or patent assets. And for this, as we mentioned, we use data from Riches and Oliver Insights. They've been nice enough to provide it to us. And we also, add our licensing transaction data from the USPTO assignments data as a robustness check to make sure that we're using two different data sets and getting the same results, just to make sure that our theory that being able to reverse an investment is correct and the results are the same. So our key assumptions here are that we are using the common patent classification system as our way of looking at technology fields or the different technologies at the patent application level. And here we're looking at all of the inventional CPC symbols. So instead of just looking at the CPC first symbol, which is more representative of the patent family, we look at all the inventional CPC symbols for a patent application to develop the full technological scopes of the invention claimed. And we're looking at this um, for the patent sold and the patents licensed. For the patent sold, uh, the patents are usually sold as packages. So it's unusual that someone would buy just one patent. Usually you're buying a package or a group of patents are sold together. And this has different ramifications for how we use this data. And we'll get into that a little bit further. But the main thing here I wanted to convey is that when we look at this Riches and Oliver data, these patents are sold as a package deal and not just one or twosies here and there. Using this data for patent sales and patent licensing, we create what we call this index of secondary market sales exposure, or ISE. And what I want to show here, and not get into too much of the detail of the math, though you're welcome to look at our formula here. But essentially, what we want to do is we want to look at the share of the technologies involved in our patent asset sales or our patent licensing sales, which we see here is the proportion amount on the right-hand side of the equation, the proportion J. We're looking at all the CPC symbols for either the patent asset sales from Riches and Oliver Insights or the patent licensing transactions from USPTO data. For the Riches and Oliver Insights, we are able to do a weighted and unweighted version of this proportion amount. And the weighted version just uses the price of the package to determine the weight of that each CPC symbol will have in our formula. And the other part of this formula that's important is this on the left-hand side here, the share I sub j, which is the share of the technologies represented by the J, or the CPC symbols represented by the letter J in firm I's overall patent application. So what we're trying to do here is we're looking at the share of each firm's technologies as measured by their CPC symbol, and we're multiplying that by their share in our Riches and Oliver data or our licensing data, and we're adding those up for all of the different CPC symbols to create our ISE. And the higher the value of the ISE, the more exposure a firm has to the secondary market for patents. And will become important as we'll discuss later, but the higher this ISE score, the greater ability a firm has to reverse their investments in their patent applications. So below, we wanted to look at the share of CPC's symbols in each of these different data sets, the secondary market for patent sales from Richardson Oliver and our licensing transactions from the USPTO assignments data set. And you'll see there's quite a lot of overlap between the two, but the distribution can be a bit different. So on our left-hand side here, we have the secondary market for patent sales, and that's from the Richardson Oliver data. And you can see it's heavily concentrated in electronic communications. Computing, makes up nearly 70% of all patent sales. And then to a lesser degree, we have other types of technologies that also are more IT focused in nature than some of the other technologies. So the Richardson Oliver data is pretty concentrated in IT. In the licensing data, which we see on the right-hand side here, we get a little bit more variation. It's still very heavily focused on different IT technologies, our electronic communication, computing, electrical elements. But the second most popular technology is medical or veterinary. So this includes a lot of, our biopharma, biotech sort of technologies. And also you can see we have some organic chemistry down below and biochemistry as well. So we get a little bit more variety in our technologies in the licensing data than we do from the patent asset sales themselves. And this is important in why we decided to use these two different data sets so that we can sample from both of them and still get the same results for our analysis. So we were finally able to put together our regression, our formula, our analysis. And I don't want to go into too much detail here because this may be overwhelming for people that aren't as familiar with econometrics. But I will point out some very simple aspects here of what we're trying to accomplish with this formula. And on the left-hand side of this formula, our P sub I T, is we're just looking at the number of patent applications filed by a firm at time T. So for each firm, we have the number of patent applications filed on a quarterly basis. And that's what we're trying to measure here. That's what we're trying to analyze. And on the right-hand side here are the variables that we're trying to account for. Like what are the factors that influence this, the left-hand side, this P sub IT, and how do they affect that? And I want to point out this beta 1 times UNC-IT. So our UNC underscore IT is our measure of uncertainty. And you may recall from our earlier slide, we have several different measures of uncertainty. And we looked at all of them. And basically this beta 1 is just going to tell us what is the response of a firm's patent filings from the change of uncertainty. So B1 UNC just measures purely what is the effect of uncertainty and how does that impact patent application filings. And the next part of this is what we call our interaction term, or this beta 2 UNC IT times ISE. So our ISE as we discussed earlier, is our index of secondary market exposure. And we're multiplying that by uncertainty. And that is telling us essentially what is the impact of your ability to potentially reverse your investments, and how does that affect your decision to seek patent filings. So these are the two important factors that we're trying to account for. And these are the two things that we'll discuss in further detail. And the rest of the equation are just our ways of our control variables. And we're looking at different factors. We're looking at a firm's research and development expenditures. We're looking at their sales, their cash flow, their credit rating, the number of employees, their industrial concentration, how concentrated they are in certain industries. And we're holding constant for firm fixed effects, both firm, industry, and time fixed effects. And these are all just kind of our control variables so that we can really focus on this beta 1 and this beta 2, really looking at how uncertainty affects patent application filings and how the interaction term, the access to the market for patents, affects the decision to seek patent protection. So we delved into this a little bit, and I'll go quickly through this part here. This is really more detail than probably most of you want to know about how we estimate this equation. But the main thing here is that we expect uncertainty as measured by this beta 1 to be less than 0. So in other words, there'll be an inverse relationship between uncertainty and patent application filings. As uncertainty increases, we're expecting firms will file fewer patent applications. But we also have this beta 2, which is our interaction term, or our ability to reverse our investment in patents. And we expect that to be greater than 0. In other words, the ability to reverse your investment in patent applications is positively correlated with the number of filings that you have. So it could potentially reverse your decision to seek protection in the face of uncertainty. These could potentially be offsetting factors. So if you experience an increase in uncertainty without access to the market for patents, you're likely to decrease the number of application filings. But because you may have access to the market for patents, that could potentially change your decision to seek patent protection. And this is just what we're trying to measure here with the beta 1 and the beta 2. So the results, we find that uncertainty has diverse potential effects. There's a lot that can happen, and it really depends on the firm level. But essentially, we find as we predicted that there is a negative association between patenting and uncertainty. So as uncertainty increases, firms do tend to decrease their patent activity. But for firms that do have access to the secondary market, where we discussed the beta 2 is greater than 0, if they do have access to the market for patents, they will continue to keep seeking patent protection even in the face of increasing uncertainty. So the outcome is really dependent on the firm and its access to the market for patents. Firms that don't have access to the market for patents, whether it's selling their patents or licensing their patents, will experience a negative relationship between uncertainty and patent filing. So economic uncertainty increases, they'll file less patent applications. However, firms that do have access to the market for patents will experience the opposite. They'll continue to file an increase of patent applications even in the face of increased economic uncertainty. And that's because they feel that they can repurpose their investments in knowledge. They can sell their patents, they can license their patents, and they're not necessarily sunk costs. Now, the ability to do this is really, as we discussed earlier, dependent on the technologies involved. So firms that are particularly in the digital technology fields, where those assets are traded frequently or sold frequently, they're the companies that have access to this market, and they're the companies that will continue to seek patent protection. So think of all your big tech companies. They are able to sell and license those patents. So when faced with economic uncertainty, they're still going to feel confident that even if they aren't able to utilize their patent internally, they can sell or license that patent, so they'll still seek patent protection. For other companies that don't have that access, if you're in these traditional technologies that we discussed earlier, you're not in the digital technologies, you're not in the biotech area, then the relationship between uncertainty and patenting is more clear. You just have a negative association. You're going to file less patent applications because you don't have the ability to reverse those investments. There's just not a market for those technologies. So here we try to focus on the resilience of firms under patenting, and as we discussed, a lot of these big patent companies, the big tech companies, or the big pharma companies, biotech companies, they have access to this market for patents, and as a result, they're not as affected by a change in economic uncertainty or an economic shock as a firm that doesn't have access to this. So this changes their decision making. The changes how they feel about whether or not they're going to seek patent protection. So finalize here, almost done. We're looking at this from a policy perspective at USPTO. We kind of understand that an economic shock doesn't necessarily mean there will be decline in patent filings. It's a lot more complicated than that. There are many factors to consider, including this, access to secondary market and the technologies involved in the patent applications. We want to also look at the ambiguity of this and how we move forward here and how we determine, our budget and how we determine our operations. These are all important factors for that. And, an economic shock may or may not, lead to a decline in aggregate patent filings. And so this is important to consider when faced with these economic shocks, is that we can't just say for sure, hey, there's going to be a decline, or even if there's an economic boom, that doesn't necessarily mean there'll be an increase. There's more to consider, and this market for patents plays a large role in that determination. I think our final takeaway here is that there's still a lot more work to be done on understanding how the market for patents affects demand for patents and affects a firm's patenting strategy. And while there is some literature on there, and we won't delve into that, there's still a lot more to be done in this area in understanding how firms seek patents and how their ability to monetize those patents in the myriad of different ways influences their decision to seek patent protection. So that's all I have. I hope you enjoyed this, but I wanted to open up the floor now to any questions. We're happy to discuss further.
Thank you, Gerard. Yes, so please submit your questions using the Q&A box, which should be at the bottom of your screen. Just type in your question there, and we'll get around to it. I suppose whilst people are doing that, just a bit of a question from me. So, I mean, this research tells us what is happening now. I suppose what are the implications perhaps for those businesses that perhaps are more limited in their access to these secondary markets, and what do you think would be a reasonable approach, or something that they could do to gain access to those markets and therefore access patents as this store of value?
Well, this is definitely a good question, and it has a difficult answer, right? It's hard to know how these markets have developed over time. Our study doesn't look into, why digital technologies or health technologies are more active in the field. And there are some people out there that have done some analysis on this, and there are different theories, but it's hard to know for sure exactly why those technologies are play a more prominent role in selling and licensing activity. And there's been literature on how it's difficult to develop the secondary market for patents. There's quite a few papers out there in explaining this. And while there is an active market, it is limited to a degree in the number of technologies, as you can see so far. Like in our data, you can see, if I go back up a little bit here, you can see obviously, yeah, we're more focused on the digital technologies and the biotech and the chemistry. So there has to be some sort of mechanism for allowing other technologies to be more actively traded, and that's more complicated because there could be business, financial reasons, economic reasons why those other technologies aren't as prominent in this data, why they're not as prominent in the secondary market for sales or licensing data. There could be other ways of acquiring the patents, or there just could be some reasons why they're not traded or licensed as much. And definitely, this is an area that requires a lot more research.
Brilliant, thank you. So we have a question here. Did you look at the green tech space?
We didn't specifically look at any space in particular. We focused more on just what the data was telling us, and we happened to focus more on the digital and the health or biotech, just because they were so prominent in our data. As you can see, they played such a big role in the the share of the patent sales and in the licensing sales. So we didn't focus on any particular one, but those technologies just were so prominent in our data that they ended up being the focus a lot of our study. But we didn't drill down much further. We in our paper we'll have a little bit more of a sector breakdown. Um, and Walter, I don't know if you want to discuss a little bit further, but I don't think you didn't look at specifically green technologies. I know we looked at a couple other industries, but we focused more on just kind of what the data was telling us, and we didn't see a lot of green tech in the asset sales or the licensing agreements.
The question here from Finbar Hughes, who says, did you encounter or identify any issues around the transparency of secondary markets for IP and how this influences a firm's approach to patenting?
There's definitely not the best data available for the secondary markets. There's a lot of data available, but it's difficult to make sense of it all from all the different perspectives. So the US USPTO's patent assignment data set has a wide variety of data in there. And you can see that's where we got our licensing data from. It also has data on the patent asset sales. And in some cases, those data do include details on the licensing agreement or the sales agreement. But those are difficult. You have to go into the PDF files and look at them. You can figure out which patents are involved in those transactions from the assignments data, but the actual details of those transactions are usually kept in private. And therefore, it's hard to know exactly like the value of a patent, or the value of a licensing agreement. In that case, that's why we use the Richardson Oliver data. They provided us that as a broker in putting together buyers and sellers of patent assets. They had much more granular detail available on the transactions, not only the patents involved, but also the package deal, like how much that package sold for, the value of that total package. Um, they had more detail on the buyers and sellers, but since we didn't necessarily want to look at the individual sales themselves, we were looking more in the aggregate on how this impacts the demand for patents. We didn't analyze it at necessarily the package level, but at the aggregate of all the packages and see what all those technologies are involved for. But there's a good amount of data out there. I think people are underestimating the amount of data that's available, but these data sources aren't the easiest to use either, and there is some issues with understanding them and making sense of them and knowing how to utilize them correctly.
A question here from Roland, who says, I can understand that firms can somewhat judge their put options, but how should they be able to make reasonable judgments concerning the call options, which heavily rely on what other market players will do? So in other words, how can they even estimate whether there will be patents available for buying?
Yeah, I mean, this is definitely an area for further research, and definitely it's not something that we're able to answer, giving our data, because we just have a sample of what transpired in the past, right? Um, and so we're just looking at these different samples of these transactions that occurred in the past, but that doesn't necessarily mean that the future will be the same, right? And there can be changes in the market, which I'm sure there are always changes in the market for technologies that are available, and you don't know until you go out there and actively seek a deal whether or not there's a buyer and a seller, and there are intermediaries like the Richardson Oliver Insights, which is a broker for which it can help you facilitate your deal. But until you are actively out there looking for a deal, it's hard to know exactly. There's not necessarily an auction. There are some auctions available, but they're not always publicly available, or they're not as easy to access, or not as well known. And there are marketplaces out there, but for the most part, it seems like companies typically transact with other companies directly, or they go through a third party intermediary to help facilitate that.
Great, thank you. Um, So I see we have a question from Christina. What is surprising in your conclusions that Dr. Park is providing an answer to? Um, I suppose, are there any other comments you want to make on that one? Perhaps that's a nice final question with which we can finish on.
I'm sorry, was that one directed towards Walter?
Well, I think so. That was directed just generally. The question was, what is surprising in your conclusions, Dr.
Yeah, I
Parker?
can just address that. I think just it was a surprise because normally I would have thought uncertainty would make firms hesitant to invest, right, in innovation and patenting. But what the surprising thing is that we found from looking at the data under COVID, under Great Recession, and et cetera, that patenting stayed stable or increased. So that's why we developed a theory and did the empirical exercise to find out. And then just going back to Finbar's question about oh, sorry, not Finbar. Let me see. Was it there was a question about uh, call option, put option. So the focus for us is a firm not necessarily buying. The unit of analysis wasn't a company deciding whether to do its own innovation versus buy the innovation from elsewhere. It was mostly about a firm innovates and then decides whether or not it should patent now and then therefore take advantage of a put option later, or should they just wait the uncertainty out, wait for the crisis to end, and then patent later? But then at that point, you always have that call option, right? You don't have to patent now; you can patent later. But during that time, first to file, others could come in. And then on the transparency issue, I think Gerard, you answered it well. We don't need as much detail as you might have for the equities market. For us, we have it's clear that these were the portfolios sold at this price. And there's whether you can do a transparency analysis to see if the patent is valid, all that. We didn't get into that, right? Because you could be selling a patent that later is not really fully valid. That's the risk to the buyer. We didn't do these due diligence issues, right? And then I think if someone else named Anson Jose had a huge number of econometrics questions, but on multiclinarity, we checked. There's no issue about that. I think he's referring to the fact that we have a lot of these variables. Do they replicate one another? We were debating whether sales and cash flow, do they send distinct messages or are they alike? So we did those kinds of analyses. But we think that our right-hand side, our variables that are used to explain patenting span, the typical determinants, right? So we took into account both push and pull determinants of patenting, right? Like you have R&D, you've done a lot of R&D, so therefore you'll have lots of ideas to patent. Size of a firm, we looked at all that. And then controlling for all that, we then specifically looked at the role of uncertainty, and then also look at the role of uncertainty conditioned by the level of access to secondary markets. So thanks.
Brilliant. Well, thank you everyone for your time. Thank you especially to our speakers. That's a hugely interesting presentation and I think confirms the incredible complexity that's associated with IP and the ongoing need for research such as this to try and uncover some of these questions. A reminder that Oxfirst hosts many webinars like this on a regular basis. Best place to keep up to date with those things is on our website and also on LinkedIn. We also publicize these on our mailing lists, so please sign up for that on the website as well if that's of interest to you. Thanks again to everyone, and I hope you have a really good day.